Good afternoon, and welcome to the Harvard Business School Club of San Diego CEO Forum. My name's Edward Hughes. I'm the president of the club. I'm delighted you are going to join us today. I think it's going to be a really interesting hour talking with Oren Zaslansky. I'll introduce him in just a minute. But first of all, again, thank you for joining us, and thank you for our sponsors. We have a number of HBS club members, and we've got some guests on as well, and I think some mutual friends of Oren's and mine. So welcome, you guys. Hopefully this is going to be fun and entertaining and obviously educational. Our mission as a club is to continue to educate leaders who make a difference in the world and make San Diego a great place to live and work. And we do that through a variety of things. Some of you will have seen our full newsletter, which kind of talks about the programming and the mission, some of the activities we've done over the last year, and some of the things we do from a social enterprise perspective. So if you haven't seen that, take a chance to go through that. One of the core things we do is what we're doing today is talking to CEOs, and we talk to them across a variety of industries. These are some of the people that we've had over the last year. You can see Stone Brewing, Callaway Golf, now Top Golf, Cirrus Aircraft. We've had a couple of HBS professors. We've had some interest in talking about some of the energy and sustainability things in San Diego, so the Water Authority and power. Former Navy SEAL, which was terrific. And then just a couple of weeks ago, we had David Abeles, the CEO of TaylorMade Golf, and talking about some of the things going on in that industry and his company. We have a couple of things that are coming up that have been published. The holiday party is this Saturday. So it was sold out. We just had a couple of cancellations. So if anybody here is a member, it's members only. Please sign up for that. We've just got a couple of tickets left on that. In January, we have Mick Farrell from ResMed talking about MedTech and what's going on in that industry, as well as ResMed. And then kind of excited about this one, which is San Diego Football Club. So as many of you know, the MLS has given an expansion team to San Diego, and we have Tom Penn, who used to run the LA Galaxy, going to talk to us about what that looks like, and that they open up as a team in 2025. But sports is obviously kind of cool, and so we'll have an interesting discussion there. Second thing we do is our management development programs. What we try to do is bring a little slice of Boston to San Diego, and we do that with a couple of programs, a for-profit program and a non-profit program, which we do in the spring. The non-profit program is coming up. So for those of you who are involved on boards of nonprofits, please, take a look at our emails. It's going to be about 45 people. It's 7 weeks. It's 2 classes a night on a Monday night in Sorrento Valley at the Honor Foundation. And we get just absolutely fantastic feedback. And the third thing we do is, in conjunction with our mission to make San Diego a great place to live and work, is we support the local nonprofit community. And we do that with 2 things. One is continuing to invest in management education by sending CEOs back to Boston for a week-long program called Strategic Perspectives in Nonprofit Management. And the other is we donate a good chunk of the proceeds from our local management development programs to local nonprofits. Between those 2 activities, we've invested about $550,000 over the last 10 years in basically furthering nonprofit community here in San Diego. As I say, we've sent 44 recipients. This year, we had the opportunity to send John Van Cleef from Community Resource Center, Todd Tibbetts from the YMCA, and Drew Moser from Lucky Duck. Great CEOs. They came back really fired up about the program, really excited to implement some of the things that they've learned in the community. And as I say, we have this local nonprofit program coming up. So again, we haven't sold out yet. We probably will sell out. Last year, I think we had a waiting list of about 20 people. So please encourage any of your nonprofit contacts to get in early. And the final thing is some social networking type of things. As I say, we have the holiday party coming up. We're going to be doing a quarterly members happy hour, and then we're going to do some panels, San Diego Aerospace Museum and innovation panel as well. Today's format is a webinar format, so it's just going to be myself and Oren on. And we do that because sometimes we get people leave the mic open, etc., and it gets distracting. So but please, type in your questions. I'll try and, I'll be looking at them as we go through this webinar, and then I'll try and get to as many as possible at the end of this. So with that, let me introduce our guest today, Oren Zaslansky. He is the founder and CEO of Flock Freight, which is a freight tech company, and he'll explain what freight tech to us is in a minute. Obviously, global logistics is a huge industry. He is a serial entrepreneur. started a business at 21 in the freight business, which is awesome. Started another business called Sole Source Logistics, and that's where I met him. He was running that when we were both in the YPO together. And then he decided to start another business, which is now called Flock Freight, and he'll talk about what he's doing with that. But obviously, that has taken off. You saw in the brief bio that we had on the website. Within 6 years, he joined the Unicorn Club, and we can talk a little bit about that. He's raised about $400 million. He's in a whole bunch of top lists, top 50 disruptors, top 100 most influential companies from Time. So, Oren, you're in Chicago, but we know you're based in San Diego and you flew there today. So welcome. Thank you for joining us.
Thanks so much for having me. Wow, what an esteemed crowd. So I feel privileged to get to share my story with the group. And by the way, kudos to all the different programs you guys have going on, especially on the nonprofit side. Some of them are very near and dear to my heart. So really excited to be here.
Well, it's great to have you, and I know you've got a tremendous San Diego connection and community. So, if it's okay with you, I'd like to kind of split this into three parts. First, let's talk about the freight industry. Obviously, many of the participants here are in business, and people like myself, we use freight all the time, but I don't know much about the freight industry. And then we can talk about Flock Freight and what you are doing there and how that's different than some of the other companies you've either started or how it's different than some of your competitors. And then maybe just talk a little bit about you, but maybe give a little background on the freight industry or a little overview for those of us who don't know much about it.
Yeah, I think the way I would tee it up, particularly for a crowd with this level of sophistication, is that the investor community would say, we know the space is very big, we just don't know if any real money can be made in it. And I think that that's a fair characterization. So the global, whether you call it freight or supply chain, logistics, it's actually not all the same thing for somebody like myself who's been in it now for almost 3 decades. But let's just lump it all into one and say it's $7 trillion a year globally. So we're talking healthcare big. There's really precious few industries that are as large as freight. And it's probably obvious why. Everything is fundamentally made over here and consumed over here. And so those things have to be transported in between in one way, shape, or form. It's about 1 trillion in the United States. So obviously a massive proportion of it is here in the US. And then we segment further, not verticals, but industries within the US 1 trillion. So the largest single bucket is what's called the full truckload industry. That's the big, often referred to as semi-truck or tractor trailer on the highway. And that's functionally, you're a manufacturer, you've got enough goods to fill up the whole truck. It leaves your dock, it goes directly to destination. That's about 400 billion a year of the 1 trillion. The less than truckload or LTL industry, that's, I've got 4 or 5 pallets to ship. I don't have enough to fill up an entire trailer, but sort of too big to give to UPS. That's about another $80 billion. You've got the parcel industry, which is FedEx, UPS, DHL, folks like that. That's like $150 billion. Then you would have ocean freight, all the containers traveling back and forth across the US on the rail or on the ocean, air freight, household goods, so on, so on. There's all these different aspects of it. What I think a lot of people miss is that it is enormously fragmented and enormously complex. So I think one of the things that I really love about working in this industry, well, there's many things, if I'm candid. One of the things I love about this industry is very, very real. I'm like a tangible person and I enjoy working on a tangible problem. It's fun to be esoteric and imagine a future, but I really get a lot of joy over the notion that we're delivering food for people to eat. During the pandemic, crazy time, I think it's something you and I will probably touch on in a minute, but being an essential service provider, I don't think people thought about the supply chain. Certainly we didn't talk about it as much in mainstream circles as we did during COVID, that the supply chain is a real thing. And it is complicated. These industries, it's very high for the most part, infrastructure, so high cap and OpEx. And therefore they are more than verticals. If you're a trucking company set up to do one thing, you don't necessarily do something else. It's just too complex. That being said, a firm like Amazon is absolutely blurring the lines. We are seeing, people will ask me often, well, who's going to compete with Flock or who's going to compete with somebody else? Who's going to enter a tertiary market and scale it out? And increasingly, my belief is, I don't know that we'll see a ton of, we can look at parcel, FedEx, UPS, you've got a letter to ship or a small package to ship. I don't think we're going to see a startup go out and raise a $2 million seed round and say, I'm going to build the next FedEx, but I'm going to somehow digitize it and make it more efficient. I think what we will absolutely see is Amazon will do it.
Okay.
Amazon will become the next great parcel carrier. They will become the next, middle mile, meaning the big trucks on the highway. I think we will see a lot of those blurring of the lines because of the infrastructure and the scope and the capitalization that they have already. But otherwise, it is really, really fragmented, which of course, creates a lot of opportunity.
That's great. I mean, obviously massive. You mentioned the pandemic. As a business CEO, I mean, we had just tremendous challenges, prices through the roof,
Yeah.
getting stuff. So, what happened in the pandemic? How did freight, kind of get through that? Because I mean, it was a roller coaster.
Yeah, it was wild. We had the same challenges everybody had where we went remote, work from home. How do you manage that business, remote workforce? I think all of us were relatively savvy with messaging and laptops, but at the same time, I certainly had never run a fully remote business before. Me and my team didn't have those skills, but we were all in it together. We all sorted that out. We had those challenges, but in addition to that, working in the supply chain, what we functionally saw was after Q2 of 2020, which was basically a freeze, everything just kind of locked up. That was terrifying for whatever it's worth. And I suspect I'm not the only person on this call who went through this. We started modeling scenarios between our in retrospect, it's kind of funny. Our upside case was flat, was 0% growth. That's what we thought our upside would be because we saw manufacturing shut down.
Right.
We just didn't know. And then we had various downside cases. If we're down 10 or 20%, if we're down 30 or 40, if we're down 70 or 80%, I had plans in front of me to go nuclear winter, to effectively decommercialize flock freight and hold on to R&D. So effectively let go of all the salespeople, let go of everybody in finance, everybody in marketing, everybody in operations, let go of everyone, and just hang on to R&D and we're a venture-backed business, so not yet profitable. So take the burn as low as possible, take the balance sheet you have and stretch that out to a post-COVID world. And again, I think for a lot of us, if we recall, we didn't really know what that meant. We just sort of said, I don't know, this thing will end. I'm not going to shave until it ends. 6 months later, you're like, okay, this is a problem. I need to get a haircut and I need to shave. For us, we boomed. I mean, absolutely boomed, as did the supply chain. Why? You couldn't go to Hawaii, but you could buy a dishwasher, and you had some stimulus cash, maybe, depending on, where you sit kind of in the consumer stack. So what we functionally saw was a few things. One is we couldn't get toilet paper because the supply chain is actually very, very efficient, not inefficient.
Right.
I sort of, as a freight guy, I take umbrage with people throwing rocks at us and saying, how inefficient must the supply chain be? It's like, no, there's only 3 days of toilet paper in the channel. That's
Right.
You're welcome. That's amazing. That kept consumer costs very, very low because nothing was being stored. Things were coming off a manufacturing line or off a container from Asia, loaded on a truck and sent straight to the retail outlet, put on a shelf and sold within a couple of days. Very efficient. People are probably familiar with just in time or JIT logistics. So, we as an industry had perfected is a big word, but gotten very, very good at it for sure. When things locked up, there was nothing, left in the channel. Then after, 2-3 months, when we kind of started figuring it out, we started working from home, and demand spiked, and everybody's seen these charts, but we saw a massive spike in goods, not so much services. If you owned and operated a hotel, you were just unlucky. If you owned and operated a manufacturer of PPE, you were just lucky. And we saw those customers boom, so much so that there were functionally not enough trucks on the road. So if you imagine this massively fragmented, a couple of million discrete, unique trucking companies in the United States, but imagine that that's like a US fleet, as if it was one company. It's not, it's a couple of million, mostly mom and pops. But just think of that as the US fleet that is rolling goods or rolling GDP throughout the US. We didn't have nearly enough of those trucks. So a massive amount of additional supply came into a massive amount of additional demand. Demand went up. Again, you couldn't go to Hawaii, but you could buy a dishwasher. So that dishwasher had to be shipped. And we all know this from commodity prices. We saw massive inflation. If you tried to do a home remodel or something, forget about it. It took you forever and you paid twice as much for the TV set of the refrigerator. When it comes to a post-COVID world, For those of us that work in supply chain, all of us will basically give you the same answer. When did COVID end? May of 2022. May of 22 it ended, because all of our charts were going like this, and then they fell off a cliff. We saw within nearly 90 days, so call it Q2 going into Q3 of 22, a reversion to the mean. So our demand didn't crash in absolute terms, like not GDP recession, but freight is so big, $1 trillion in the US, we have our own economy. And believe it or not, that economy is not entirely tethered to GDP. The freight economy is tied to supply and demand. It's actually a very efficient industry in that regard. So in peak COVID, we saw like literally 5 loads that needed to be moved with only 1 available truck. What would happen in a free market system, the trucker would charge more. And all of a sudden, 5 different shippers with 5 different loads would start outbidding one another, because they needed access to that supply. And if you needed PPE as the consumer, you didn't really care what the mask cost. You were, okay, it's not $1 now, it's $3. I'll pay $3. I got to have a mask. I can't go out, or I need the gloves, or I need toilet paper, quite frankly. Once people in May of 22 decided that they weren't going to buy a dishwasher anymore, now they could go to Hawaii, all that demand crashed, but all that supply was still in the system. So then all the prices crashed, and we saw massive, massive deflation. And when I say massive, ground freight, my world where we live, trucks on the road, we have a special spin on it, but it's still a truck rolling on the ground. We saw about 50%, 50 deflation in 90 days. So we call it an AOV, an average order value. My average order value, my cost of procuring transportation to go from A to B went from $2,300 to $1,100 in 90 days. So, an intermediary like us is looking to capture a percentage of that transaction, convert that to gross profit, and send it down the P&L. You watch that real dollars get cut in half, you've got a problem. And boy, have we all been fighting for our lives, for the last 18 months. But that's not as bad as it gets. The biggest inflation and therefore deflation was ocean freight. And we've all probably seen the 100 ships waiting off the port of Long Beach at San Pedro to be unloaded. That was very, very real. Sure, there were some publicity stunts around it, but it doesn't change the phenomenon that was a huge problem, if not a crisis. We saw, give or take round numbers, the cost of shipping a container from the east coast of China to the west coast of the US, sort of Shenzhen to Long Beach, went from $2,000, $2,500 per container up to like $22,000 per container during the COVID period, 10x. And then it crashed. Now, it didn't crash quite as fast as ground freight. We were like 90 days, and we bounced off the bottom and stayed there for the last 18 months. Ocean took some time, but it has fundamentally, and I don't work in ocean, I work in ground, but it's a tertiary, it's an adjacency to us. So it's something that we have our eyes on. So I don't know if it's all the way back to that $2,000, 2,500, but if it's not, it's like $3,000. I mean, it's basically back to where it was. So there's the second story of COVID. So for those of us working in it, and I'd ask anybody on this call to imagine you staff up your business, and God forbid you're actually investing in hard assets and infrastructure. In our case, we didn't. The staffing was people largely, and facilities. But that line item, our P&L is certainly talent is the number one cost of doing business. We hired and hired and hired, and we boomed and boomed, and we had lots of volume. And then all of a sudden, even if your volume was flat, you didn't have any less volume, your revenue got cut in half overnight. Therefore, your gross profit dollars or contribution margin or gross margin, however you categorize or define that, got cut in half. It's been a challenge. It was definitely a tale of two cities for our industry. We've now, coming off the greatest boom, what goes up must come down. We're now hopefully exiting. It certainly appears from the data that we see at Flock, and most of us discuss within the industry, seem to be exiting the worst freight recession in history. The recession is so bad that at the end of the day, the trucking companies cannot operate the vehicle profitably. I mean, literally, you can't buy gas and put tires on the truck and pay a human to drive that truck. We're not talking living wage or whatever. We're saying like it cannot be done for more dollars in than going out. So what we see is a massive amount of bankruptcies. And so companies are failing one after another. And I know you and I chatted on yellow freight. That should startle people. That is a 99-year-old. People can throw rocks at a flock, at a venture-backed business. Is this real? Is it great? How profitable is or isn't it? Yellow is a 99-year-old trucking company that specializes in the movement of LTL. So just 3 or 4 pallets, not filling up a whole truck, but more than FedEx would do, but less than a full truckload trucking company. 99 years old, 33,000 employees. And it had been, performing poorly for decades, so over my career, we had often worried Yellow Freight would go out of business. And it had been bailed out a couple of times by the feds, even the US DOD, private equity, capital markets. But ultimately, they closed their doors, several months ago. Interestingly,
doors, or did they do they're in a bankruptcy, Chapter 11 restructure? I mean, are there any Yellow trucks on the road at the moment?
Not to my knowledge. They closed. They shut it down. They had massive balloon payments due on insurance, on debt. These are pretty big numbers. Ultimately, I do not believe the company was restructured. It closed. So, 33,000 people out of a job just like that. Yet, freight is so big, I didn't feel a ripple. It's hard to imagine that, but that, one of the largest and oldest trucking companies in the United States went out of business. It speaks to how large the industry is. It speaks to how fragmented the industry is. It also speaks to how much excess supply exists in the industry. So we just keep seeing companies failing one after another. It's hard to see. You see it when it's Yellow Freight because it's, front page of the Wall Street Journal. It's notable, but 80% of the trucking companies in this country are mom and pop businesses with between 1 and 5 trucks. That's the long tail of the industry. And there's a couple of very large ones, Swift, Knight, Schneider, JB Hunt, the 10,000 trucks, 20,000 trucks. They're notable. They're huge. They're publicly traded. But the long tail is 80% are Bob's Trucking and Susan's Trucking. And so they're failing every day. And it's hard to see that. There are some ways to infer that data. But you can't exactly go to the journal, so to speak, and see the number of trucking companies that failed that day. There's no sort of obituaries for this. But of course it is happening. And so then we start to see supply and demand normalize, rates stop crashing. And now there's a little bit of inflation in my world. I know it's not necessarily great for consumers, but we need some inflation. We have to have it. And I mean outside of fuel. Fuel inflation is a pass-through. It goes to the truck to buy gas for the truck. But for the rest of us, it just got a little out of hand. It really has crushed this industry, but seems to be on the rise. The good news is not going anywhere, right? That $7 trillion, everybody still needs to eat. So
still got to move stuff. Let me, I'm a little confused. So I get the spike in the pandemic. How did supply come online? I get people can suddenly become a driver. But if I'm going to become a truck driver, I got to go get a truck, right? I mean, there wasn't just a surplus of trucks just sitting around to suddenly create this huge supply boost, right?
Well, I happen to love pickup trucks. I kind of always have a pickup truck in my life. During COVID, not to be opportunistic, but more because I seem to also have a very short attention span. I sold a few trucks. I would buy it new and I would sell it. And I was able to sell them for more than I paid new. Okay. Now, I was not attempting to profit on these things. It was like I was dealer trading. You buy a truck for 50 grand, drive it for a year, take it to a dealer, they give me 55 and trade. I'm like, I don't understand the math, but they were selling it for 60 or 65. So new truck manufacturing, Daimler, Volvo Group, Mack Truck, Kenworth, they cannot just accelerate their supply chains because the whole supply chain is jacked anyways. Secondarily, it's a complicated business making a Class 8 tractor to be sold. The used market went nuts. There is a massive mobility of talent between the construction industry and truck driving. Right. So these are very complementary industries. They're often counter-cyclical, which can be great. So you go from swinging a hammer to having a commercial driver's license, a CDL, and going back and forth. So, construction at first kind of like everything stopped, but freight had to keep moving. So what we saw was a bunch of people, jump out of one industry and into the other and started buying up used trucks at a huge rate. But know that ultimately, if you're talking about like a yellow freight, which is an LTL carrier, these are hub and spoke terminal operators. Their infrastructure looks like UPS and FedEx without the airplanes. LTL looks like big trucks, little trucks, warehouses, terminals, forklifts, labor. It's 300 terminals throughout the United States, kind of slowly inching your pallets of freight across country. That does not change overnight, nor did it. So those prices just skyrocketed. Supply was not able to come in and meet demand. Supply chain slowed down. But for the full truckload industry, if you have a license to drive a truck and you've got an entrepreneurial spirit, all you need is a truck and maybe $1,000 worth of permits, some paper that gets pushed. It doesn't take a lot. You do have to buy the truck, or you can lease the truck, right? There's somebody out there who's more than happy to finance it for you. So what we saw was really independent owner operators come in, trucking companies of one, or we saw these trucking companies of three go to four. But that's 25%, right? I mean, that's like massive growth for the U.S. fleet, so to speak. We didn't see as much of the mega fleets, the Swift, Knight, JB Hunt, Schneider. These are the 20,000 trucks. They're obviously going to be more thoughtful, cautious. These are multi-billion-dollar public companies that have EPS concerns. They can't get behind it, but they can't overinvest, and because there's always a cycle, and they know that cycle is going to come to an end. But if you're a small fleet of four and people are throwing gobs of cash at you, like you're literally now getting paid double. Your cost is about the same, but your price point just doubled. I mean, it's intoxicating. And so, yeah, you're going to find a way to get your hands on a couple more trucks and a couple more drivers. Construction got slow for a while, so I might as well jump back into trucking. So that's what fueled the increased supply side for the entire industry. And by the way, thankfully, that's how we ate. I mean, the store shelves were running dry, if we recall. I mean, it was really kind of getting quite interesting for a period of time.
And so, there's all kinds of news coming out from the Fed, et cetera. We've kind of flattened out, hopefully, on interest rates, looking to potentially come down next year. There's talk now, the analysts are saying, hey, we're going to have a soft landing, avoid a recession. Freight, I'm assuming, is a pretty good leading indicator of that.
Yeah.
Are you feeling like, things are starting to pick up and volumes are going to be picking up again through next year?
Well, we expect two separate forces. One is we expect some inflation, just pricing inflation within our industry, not tied to the good that we're shipping, but with less supply, ultimately having, fail to the point where we hit bottom, then we get to parity between supply and demand. Our cost basis, therefore our price points stabilize and they start to expand. We're projecting, if this is helpful to anybody on the call, about 30 to 40% inflation at our average order value, which will literally translate into 30 to 40% inflation on your cost of shipping goods. By the way, that's not actually high. That's recovering back to like a healthy, vibrant place. COVID was way, way higher than that. So if this sounds like bad news, I mean, I get it is. I do get that, but we're not in a sustainable place. Companies are failing, and then if you can't get your goods to market, it doesn't work. So I would say for those of you that are spending $1,000 to ship your stuff, that you make to your customer, expect by Q3 that might be $1,300 to $1,400. That's our point of view. Flock happens to have here a guy named Chris Pickett, who's one of the industry foremost kind of macroeconomists and expert on this cycle of demand curve or supply side curves. So that's our point of view. In terms of the economy in general, it is still going. It is kind of what we hoped a year ago. I was, at these events and those events, and we all go to these things, and you hear the world's foremost experts chatting on this. And Goldman just came out with their 2% GDP expansion in 24. Hopefully, we see 325 bip cuts in 24. These are forecasts. Who knows? The Fed seems to be signaling that as of yesterday, which, boy, do I hope that's true. Yeah, cut a little more. I wouldn't complain. Yep. It seems to be relatively accurate. It's messy in freight because there's a churning of what's being produced and what's being sold. So you don't want to be over indexed to any one kind of industry or vertical within the industry. But generally speaking, we have seen demand absolutely hang on. It has not fallen off a cliff. And I think the forecasts seem to be that it'll continue to hang on. I don't think any of us in the industry side, because you're right, I think we are a leading indicator. I've often said that those of us who work in freight, we're like Joe economy. We really see what's happening. It seems to be doing okay.
Okay, well that's good news. All right, let's switch gears a bit and let's talk a bit about Flock Freight. And you call it a freight tech company. It's got a focus on sustainability. Obviously, we're just coming out of COP, 20A or whatever, and the trying to transition away from fossil fuels, blah blah blah. So, what's the play? What?
Yeah, so we are a certified B Corp, and the only one in freight. So it's a real part of what we do. Um, we do ride sharing, algorithmic carpooling of freight. So the two ways to think about Flock. One, as I mentioned before, yellow freight, operating 300 to 500 terminals throughout the US, big trucks, little trucks, warehouses, terminals, forklifts. It's complicated. If I say that and you're like, ick, then good. Like that's kind of how I want you to feel, is viscerally like, that seems complicated and expensive. And of low quality. In freight, we define quality as on-time pickup, on-time delivery, loss, theft, damage, and how long it takes to get your goods, kind of standard KPIs. We go to customers and say, instead of taking your 4 pallets, 6 pallets, 8 pallets of manufactured anything, like it matters, but we're in the widgets business. We, instead of giving it to yellow freight or their other contemporaries that manage through these terminal network, we will put it into a ride share environment. So we will be what we call hubless, without a hub. We have digitized it. And it is a non-trivial pursuit from a technological standpoint, as well as from a commercial standpoint. So instead of saying, I'm going to watch my 4 pallets move on 8 trucks with 8 drivers through 8 terminals between LA and Chicago and kind of slowly play Frogger cross country, we are digitally aggregating all of this freight across all these customers. And instead of going to the LTL industry, I mentioned before about an $80 billion industry, instead Flock goes to the $400 billion full truckload industry. And we say, we're going to find a big truck, the big tractor trailer you see on the highway, and we're going to ask it to make multiple pickups, go to customer 1, then customer 2, 3, and 4, and then drive and make multiple deliveries. Early days, it was very clustered. Like I had to get 3 or 4 pickups done in LA with 3 or 4 pickups done in Chicago, or deliveries in Chicago. Today, we've got tremendous compute, tremendous probabilistic capability. We can actually kind of see the near-term future. We can guess that, hey, we can get a couple of pickups done in LA and just send the truck towards Chicago. We're super confident that a customer in Phoenix is going to say, oh, I need your services now going somewhere along that route, or a customer in Denver, a customer in Kansas City. So now it's like anywhere along those routes, in the way that like a train or a bus, the train doesn't need to be full in San Diego and then drop everyone off in LA. Like they're going to stop at multiple stations along the way. We now have an ML probabilistic pricing capability where we can guess into the future whether other customers show up in time and space and get that truck full. The reason the customer does business with us is because the full truckload industry picks up 97% on time, delivers 97% on time, has the fastest possible transit time, drive, stop for food and gas. No damage and loss and theft because it just sits on the truck. Versus LTL is like the terminal infrastructure hub and spoke people. That's like a 70% on-time pickup and a 40% on-time delivery. Takes twice as long to get your goods. Things get lost, damaged, and stolen. So for possibly anybody in the call who's in the manufacturing side, most manufacturers need a little bit of both. They ship full truckload, and that's great. It's cost effective and very high quality. It's what we want. But they're also probably sending out LTL or less than truckload, and they just kind of cross their fingers and grit their teeth. They get a very bad quality experience. We can digitally aggregate, consolidate without any assets, without any infrastructure, and put it to that full truckload environment. The other half of what we do, using the same core technology, which I can speak about, it's actually 2 pieces that are now patented, is that every other truck on the highway is half empty. Right. Like that's a shock and awe statistic. So we're talking about a $400 billion full truckload industry every year in the United States. Every other truck we see on the highway is half empty. So we go to those customers and say, hey, for every other truck you're full, awesome, do that. I mean, you can hire Flock to do that, but you don't need to. And it's a small percentage of what we do. We don't go to market that way. We tend to support that need when we're already embedded in a customer doing the things that we do that no one else does. And they also ask us to provide that capability, and we can do it. But on the every other truck, the one that's half empty, That's where Flock is really special. We go to that customer and we say, why would you pay for the whole truck? We can sell you a half a truck. We can sell you a third of a truck, two-thirds of a truck, three-quarters of the truck, because we have the ability to match things with things, make sure that it never comes off the truck. It's always hubless without the hub, without the terminal. We can still give you all the very high quality of full truckload, 97% pickup, 97% delivery, and do so in a way, though, with like zero damage, no risk, and save you a ton of money. So our enterprise customers are very big. You know, these are multi-billion dollar kind of Fortune 500 customers. We can go to them and enter into their truckload programs, which are huge. In some cases, billions. In most cases, hundreds of millions of dollars being spent on full truckload. And we go in and we say, look, your truckload program is $500 million a year. And half of that, 250 million, is great. It's efficient. It's optimal. But the other $250 million worth is suboptimal. You're paying for a whole truck. You're not getting it all the way full. We can save you tens of millions of dollars by giving us the freight that you have and letting us worry about matching it up with other people's freight. So kind of taking the smaller shipments and taking them off the hub and spoke and putting them into this truckload environment. We call it shared truckload. You're sharing the truck, or you're paying for a full truckload, but you're not getting the truck full. Give us that freight and we will match it up and move it in the shared truckload environment. In order to execute on that, two forms of patented IP. One is an optimization engine. That's the algorithms that play Tetris with the puzzle pieces and figure out the truck. Super hard, much harder than people think. If you imagine Uber Pool, you know, they have this carpool for rides. Like you and I could go on our app and select a pool and we save 10%. And if we want to do that, we do that. Uber does not have to constrain for our gender. They don't have to constrain for our height and weight and our hair color. None of these preferences matter with humans. They're just going to pull you together. But with freight, we have to algorithmically constrain for length, width, height, and weight of the freight. We have to constrain for the density of the freight, the value of the freight. We have to constrain for the compatibility of cargo. In theory, you can put any two humans in a rideshare together, and that's just fine. But in freight, you cannot put hazardous materials with frozen food, with fresh flowers. Like these things do not all cohabitate with one another. So we have to constrain the search space accordingly. Additionally, in the Uber Pool example, they don't even know if you got in the right side of the car or the left side of the car, or that maybe you sat in the front seat. They don't know, they don't care, it doesn't matter. With freight, everything has to be in what's called LIFO sequence, which is last in, first out. There's only one way in the truck from the back and only one way out through the back. So if you're the first thing in, you're going to be the last thing to come out. If you're the last thing in, you're the first thing to come out. All of that constraint work has to be done. Flock is commercial 8 years now, but I was working on it for about a year and a half prior. So it's like 9.5 years of work on the optimization engine to get to where we are. But then we also have an ML, a machine learning probabilistic pricing engine. So we have to be able to, if you come to us and say, hey, I make stuff, I got a half a truck, can you pick it up tomorrow and what's it going to cost? I have to make many guesses in that, but the most challenging guess that no one's ever attempted to make before is, if I sell you a half a truck, am I going to sell the other half of the truck? Is another customer going to show up in time and space and want to ride share with you reasonably along the route that you're going to be traveling? And if we can make that guess really well, because we're going to take the balance sheet risk, we're going to go ahead and give you a price and honor it, and we're going to confirm the whole truck. And if I've only sold half of it, I'm going to eat the rest, and that's bad. But if I can get the whole truck sold to 2, 3, 4 customers, that's kind of the common use case, then we unlock the highest gross profit percentages, the best unit economics ever in the history of the industry. Very low margin industry, to be fair, but we've actually already surmounted those unit economics. We actually, not for like wide public consumption, but so I won't be too specific, but I can say that we now actually have the best unit economics in the world. For what we do, far past $20 billion revenue, massive 100-year-old, monolithic incumbents that have been doing it forever, because we're not just reselling assets. We're using this software capability to kind of change the mousetrap, fundamentally change the rules of the game.
Wow. And that's really interesting. So what is your success rate of being able to consolidate and sell the other half of the truck? Because I mean, it sounds like you are taking quite a lot of risk, right? If you are committing a price and saying, hey, you're going to pay X for this based on, and you're assuming you can fill it, right? So you're pretty good at filling the balance.
Yeah, that's kind of the number one investor questions. When I'm meeting with people is, So the risk cuts both ways, because if you get on the right side of risk, it's your moat. It's how you defend your business, because we have so much data that nobody else has, and our ability to make these predictions. But if you get risk wrong, then it kills your business. The punchline is we are now today in end of 23, excellent at it, like really, really good at it. But that was not true in the early days. We were getting crushed in this. And part of it is chewing the glass of accumulating all that data. You just need so much data to tune and feedback these ML models so that they can start to get smarter and smarter. You've got to spend the time to build out the neural nets and take in data from every possible place. These are sometimes what's called non-expletive. So you don't exactly understand why it's making the choices it makes, yet you're commercial. So you're just trusting a robot, which is pretty unnerving. We have learned how to mitigate a lot of that risk. So it isn't just an absolute, we're good or bad at making the bet. It becomes, we do something almost nobody else does. We surge pricing up and down based on the ML box's interpretation of probability of risk. So if it says risk is high, you want to buy half a truck, we don't think we're anything else to go with it, we'll push the price up to a place where we're reducing that risk because we're capturing more revenue. If we get it right, boy, we smash margins. If we get it wrong, maybe we lose a little bit of money, but an acceptable amount of money. We also have learned to play portfolio math. A traditional freight broker is thinking very much like, I need to make $100 every load, and I'm going to move 1 million loads, and so $100 million. Like, that's how it works. With Flock, we can't think of it that way. We play portfolio math, thinking about it. How did the whole company perform today, or this week, or this month, or this quarter, or this year? So we surge prices up and down based upon our point of view at a tactical level, shipment by shipment by shipment in the spot market. And that's something that our intelligence has given us, our software capability has given us competitive advantage. The other thing that we've learned to do is the customer promise is a little bit nuanced, is not the shared truckload per se. The customer promise is that it's hubless. Moving through the terminals is the root of the badness from a quality standpoint. The customer actually wouldn't care if we bought a whole truck and only put one pallet on board. Our board of directors would care. Like, that would be really bad economic outcome. But to the customer, that's just fine. So what we've learned how to do is, so to answer your question a long-winded way, and I apologize, I can't be too specific here. The majority of the time, these things are landing in these beautiful shared truckloads, making very, very high margin. A minority of the time, they don't, but we have to meet customer promise, and we don't want to buy a whole truck and only get it a quarter full or a half full. So what we've learned to do is we find empty space. We call it find and fill. So if every other truck on the highway is half empty, which is true on the demand side to the shipper, that means on the supply side to the trucker, the same is true. Half those trucks are running around with empty space. They come inbound to us digitally, they enter into auctions, they give us their data, we know they have some empty space, and we can take that 4-pallet shipment or 8-pallet shipment and put it on the end of their trailer, where we don't control the whole truck, but we're kind of Airbnb supplier surplus. We're buying, contracting that excess or supply inventory for the period of that trip. And when we do that, we don't make the big windfall margins that our business is optimized around, but we have figured out how to no longer lose money at the unit level. We always make money every time, between a little in that scenario or a lot in the previous examples.
So how do you come up with this idea? You were running sole source, right? And then all of a sudden you say, I want to start a new business. What was the genesis of that?
Yeah, I'm an insider working in freight, and I'm frustrated that parts of this industry work really, really well. The full truckload industry, very efficient, largely. The LTL industry, super inefficient. I'm frustrated that truckloads are half empty half the time. Got to be a better way. Admittedly, I tend to be a why not me guy as opposed to a why me guy. And so I thought, gee, if I had infinite time and money, the magic wand, how would I do this? I would algorithmically carpool everything. I would digitize the very infrastructure of the US supply chain and ultimately global supply chain. I would deconstrain it. Instead of saying trucks can only do certain things and they're optimized, and supply chains have been optimized to do certain things. And then that optimization scheme is placed on the shipper, the manufacturer, and we tell you how to exploit or leverage or maximize that efficiency. I think that's like a weird backwards way of thinking about it. I'd rather go to you and say, what do you need? Cool, I can do that. Oh yeah, highest quality, lowest cost every time, whatever you ask. You've got to pull the rails off the system, the very infrastructure of the system. And if you digitize them, then they become very malleable. Then they become very, very flexible, and we can shape them to whatever needs you need. So I think of it as, why wouldn't we just ride share everything? There's all this empty space out there at low to no cost. We can deconstrain it. We can offer people higher quality, lower cost. I mean, in my mind, my very overly optimistic, still had red hair back then mind, I thought to myself, I'll just build some algorithms and I'll pool freight, no big deal. 9.5 years later from that statement, and 8 years later from kind of the first venture round and commercializing the business, it's proven to be like 10,000 times harder than any of us could have imagined. And not just because of the technology and the commercialization and highs and lows and capital markets, zero interest rate environment to a higher interest rate environment, but because of all the change behavior required. We've had to change the way trucking companies think about their assets. We've had to change the way enterprise customers think about procurement. Change behavior, in my experience, is always the hardest part. In order to change the industry, we got to change the way people think about the industry.
So you kind of came up with the idea, I'm going to do ride sharing, I'm going to digitize this industry, I'm going to create algorithms, etc., and I'm going to go out and raise money because it's going to take money to obviously create this technology. How was that received? You just kind of walked in and said, sure, here's a big check?
I mean, kind of, it was a little more complicated than that, but one of the things I love doing is demystifying specifically venture capital.
Okay.
I was a bootstrapper. I bootstrapped 2 businesses. I felt like I was the little guy at the table. I was profitable, made a nice living, but like venture capital, it's this mysterious, Sequoia. What does all that mean? The reality is, I was the right person to do this. I've been working in freight already for 20 years at that point. I had started 2 companies. They were successful. They were profitable. I was employing people. They were not big businesses. They were small to medium-sized businesses, but was doing okay. And Lord knows no one's going to outwork me. So, once again, why not me? I reached out initially to 2 really close friends and mentors. One of them through YPO, Jim Braylene, who I know that you know, and maybe others do as well. And Jim, to me, represented the tech founder who had raised money, who was a PhD in engineer, understood technology and product development. So I'm like, I want to see what he thinks about this idea and get his support. The other was Toby Stewart, or Professor Toby Stewart, who was faculty at HBS at the time, which is where I met him as an entrepreneurship expert. And it just became a dear friend. And I went to Toby and I said, hey, I got an idea. I want to pool freight. This is what I want to do. What do you think? And Toby has a lot of relationships, and he's an academic. He's not an operator, but he's got a tremendous amount of experience advising, sitting on boards. Certainly guys read a bazillion term sheets and thinking that through. And in the end, the 3 of us said, I can do this, Oren, you could do it. Go out and make it happen. It was daunting at first, for sure. San Diego is not a big venture town. There's back in 2015, when we raised our first kind of pre-seed, it was an even smaller venture town. It's grown a little bit, but the power center is the valley. I mean, we could talk as much about the power shifted, whatever. Yeah, I don't know if that's really true. I think kind of seed through B, C through C, kind of early to mid-stage venture is still very much in the valley. And so, I went up there and started pitching, and I got it all wrong, but I'm a salesperson until you start to get it right. One of the biggest mistakes I made was I was trying to do it my way. And I realized that's a mistake. I hate decks as a salesperson. I thought, oh, you're using a pitch deck, you're a lousy salesperson. That may be true in sales, although I would say it depends on the sale, right? But I thought that was kind of lazy. And I prided myself on, being able to do it better. But I realized that raising venture capital is quite formulaic. The term they like is pattern recognition, which is, in my experience, another way of saying bias. And they're looking for something, and they have to ingest a lot of concepts. In fairness to them, you're their 9 a.m. meeting talking about freight tech, and their 10 a.m. meetings a medical device, and their 11 a.m. meetings a golf club, and just thinking through your list of guests. Then it's the power utility coming in. I mean, it's hard for them to come in, and they have to put us into boxes and say, oh, you're kind of a this and you're kind of a that. And what's my pattern recognition around that? That's good for me. I want to invest in that, or I understand it, or I can be helpful, or it fits my charter or my mission profile. what I wished I would have known, or what I would have told myself, 8 years ago, raising that first round, is I was for sure going to get $1 million term sheet. I did not see that at the time. I thought, oh, this is so hard. It's never going to happen. I felt really insecure about it. There was no way I wasn't going to get $1 million check with an idea. A little bit of technology built. It's a pretty good idea, somewhere between good and hopefully great. I have the right background to do it. It made sense. Didn't mean that we'd be successful, by the way, no chance. But it was a rational way of doing it. And so you start practicing, but you just got to do it. You got to run those laps. Ended up raising a $1.3 million kind of pre-seed round from a fantastic, my absolute favorite investor in the world, Signal Fire. Firm up in San Francisco. The CEO founder, Chris Farmer, has become a dear friend and is on my board, and just great. And then, you work together, you start collaborating. I mean, I think VCs get a pretty bad rap, quite frankly. The idea that they just want to fire you, the founder, that is not true. That's a bad moment when they're taking out a founder, because then they lose the whole leadership team. It happens, and there's bad investors. This is bad founders, quite frankly. But you got to get in the game, you got to get started. And then once I was in the game, I had a great support system around me to kind of teach me the ropes along the way. The numbers started getting really big, and they do start getting really complicated. And having trusted advisors around you to help navigate that was the only way that I made it through, for sure. Now I feel like, okay, I understand it. It's a fluency.
So you went from Signify at 1.5 million or 1 million, but you've raised like 400 million. Who
Yeah.
I mean,
Yeah. Well, what happened between there and now? So
who's in?
We raised 1.3 in the first one, and then 6 months later, circa 2016, the markets are strong. We had good early traction, good early adoption. So then we raised like a quick $2 million off the 1.3. Signal Fire just doubled down. They basically said, look, we'll double the price. You want our money? Like, you guys are awesome. Sure. Like, I don't have to go out. I mean, we had to go into the negotiation, but I didn't have to run a process. Then we we're getting ready for the Series A. Signal Fire, as well as some other investors, kind of came to me and said, this thing's going really, really well. You can go out and raise an A, but if you want, we can make it worth your while to take in a little more capital now so that you can go a little further. So you have to go out and raise your A, and hopefully with better metrics and a better price. So we did sort of 3 rounds with Signal Fire, and they were a lead. We were bringing in other kind of smart, helpful money along the way. Then I go out for my A in mid 17, and we brought Google Ventures in. So GV led the Series A, a guy named Joe Kraus, absolutely phenomenal human being, and one of the smartest people I've ever met. Joe leads the A. That was a big level up for us. That was a big institutional name, a big brand. GV has got infinite resources, big portfolio, big brand for us to leverage. And then, at that point, I'm in the game. Now I've met everybody in venture. I know who, the kind of top GPs are at every firm that might think about what we do. If they're a fintech guy, I don't know you. If you're a social media guy, I don't know you. But if you're a marketplace GP, I probably know you at this point. Midas list guys, like all that nonsense. And you very much just kind of enter that world. A couple months later, had the opportunity to meet a gigantic $110 billion AUM private equity firm called GLP. They're really sort of like, if those of you know Brookfield or Prologis, they're like industrial asset, like they own ports. So they've got a point of view around the supply chain. They do venture investing, kind of a strategic / financial investor. They write a check. So the first check's $1 million, the next one's 2, the next one's 5, the next one's 10, kind of like this doubling on the way up. Wow, the A in between was like 15, 16 million. And ultimately brings me to 2020, mid COVID, and I was approached by SoftBank. SoftBank was just off of WeWork, like not in a good way. And it was actually a good moment in time to partner with them. They were quite humbled, sincerely. They had at the time, a really good freight logistics team out of San Francisco, led by a guy named Irvin Tu, ex-Goldman guy, just unbelievable. He's the CEO now at Naspers Prosus out of South Africa, a huge media company. But he was our managing partner, or MP at SoftBank. And, they have that playbook, like, hey, could you take down 50 million? Like, yeah, we could. And then, but it's going to be a bigger check. And then you're on the line with Masa, and Masa's like, hey, you should take 200. And I'm like, oh, like some of those stories are true, and some of them aren't true. We ended up doing a $115 million Series C. We brought Volvo Group in as a strategic because they're the second largest truck manufacturer in the world, tractor trailer, semi trucks, behind Daimler. Gave us a footprint in Europe through GLP. We had gained a footprint into Asia for future expansion. And then our numbers just took off. I mean, just went absolutely crazy. SoftBank approached me 6 months after we closed the C and said, we know you still have a huge balance sheet. You want some more cash. We'll price it well. We want to preempt anyone else. Long story short, we did a D with SoftBank about 2 years ago. That was another couple $100 million. And that one priced us at 1.3 billion, which is a 2-year-old.
That's the unicorn value, right? Good job.
Yeah.
Awesome. And then, so you got all this cash, and then earlier this year, the regional banks, some of them start to struggle. Did you have any problems with any of that?
Yeah, I mean, we bank at SVB. I personally banked at SVB. I was, over limits and not really paying attention because, bank runs aren't real. And, I never really thought about that. So fortunately, our CFO is much better at managing our cash and treasuries than I am at personally managing my money. So we were sweeping 98% of cash every night anyways out to BlackRock. So we had, Flock had very limited exposure. I mean, it was real money, don't get me wrong, but like 98% of our cash sat someplace else. The concern became payroll, like how are we going to meet our short-term obligations? Because for those of you that were at SVB, it was no joke. For Friday, Saturday, Sunday, you couldn't log into the website. I mean, I couldn't use an ATM machine personally. I remember asking a few friends, like, can I borrow a couple $100? Like, I just feel like I should have some cash on me because, my debit card didn't work. I mean, it was all locked out. Google GV stepped up. I mean, wow. Larry and Sergey, because that's how that team rolls, said, we got our portfolio. Any short-term needs they may have over the next couple of weeks, we'll backstop it. I remember getting that call from my board member GV, and I thought, wait a second, you guys have like 700 portcos between early, mid, and late. Like Larry and Sergey, they got it. They got that kind of scratch sitting around and checking, so wow. By the way, eye-opening moment. Yeah, we're $1 billion company. We feel pretty great. And you're like, man, that's real money. That's wild. It never came to that. SVB turned back on Monday. It was scary and stressful, but it was fine for the business, fine personally, as I think most people know. Shareholders got wiped out, but depositors did not. Depositors, to my knowledge, there was no capital lost. But that was exciting. We then immediately, both personally and professionally, opened up accounts at like every bank in the United States. So, we wanted to make sure that we were never in that situation again.
Okay. So I know we're coming up to time here, and this has been great. What's the exit plan?
We've always built this thing from day one to be the largest and most profitable kind of freight company of any type, although we are freight tech. And so the plan has largely always been to go public. I think 2-3 years ago, we would have said we'd be going public around now-ish. We're 8 years in, so first money in is about 8 years old, 10-year fund life. Like, yeah, that's about right. And everybody was tracking. That world froze. Fed giving us a little bit of help yesterday. So, maybe that window opens. While we have seen a couple of IPOs, not really. So you could put us in the pre-IPO category. The reality is it's probably still a couple years out because that being said, we're making the most of the moment. We are becoming a very predictable business, a lean business, thinking about, real earnings, thinking about being able to guide the markets, transforming some of the people on the team, transforming systems. We haven't gone through like SOX compliance yet, but we're taking the opportunity to get this thing really ready to go public. Acquisition opportunities may come and go. So, look, I have to present that stuff to the board, kind of is what it is. It's not where my heart of hearts is. I'd really like to take this thing public and just keep going. Flock can fundamentally change this industry, can create much, much more sustainability outcomes. You burn the same amount of diesel with a half-empty truck as you do a full truck. So we're helping to do our part for the environment. We're saving shippers money. We're increasing earnings for carriers. I mean, it's a really, really cool business. It is certainly my magnum opus. Like, yes, I've started 3 companies, but there's not another one quite honestly, there's not another one in me to do something like this again. So I wanna keep going. I feel like I still have it in me. I feel like I'm still the right person for the business. That's not entirely up to me these days, right? There's a lot of people around the table. But I think that's where it'll go. Every now and then we have, large capital pools that ask us about our interest to stay private. That people don't talk about that as much, but that is absolutely a real thing. There are lots of mechanisms to secondary and provide liquidity to early investors, to provide liquidity to not just management team, but to the common, top to bottom. And it's not something I would take off the table. I mean, never having run a public company, never having taken a company public, what little I know of it is that it can be quite brutal. And so, maybe staying in the private markets a period longer is a great option as well.
Well, the good news is you got a big market that seems like it's about to rebound. You've got some unbelievable technology and some moats that you've created. You've got a lot of momentum going into this thing. So, congratulations. This has been excellent. Oren, we really appreciate you taking the time to share the story with us. Hopefully, we're going to be cheering you on as a San Diego company. And hopefully you'll be on NASDAQ soon enough, and it'd be a great story. So I want to thank you for the time. I want to thank all the people who've been on this webinar. We've got the next one's going to be with Mick Farrell from ResMed in January. So with that, thanks everybody, and have a great, happy holidays. Okay, thanks, Oren.
Thanks so much for having me.